Corporate finance practice problem using OneNote. Preferred stock valuation calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the practice problem area, and then down in the 1034 preferred stock value tab. Also note that when using OneNote, take a look at the immersive reader. Many of our presentations here will be mirrored down in the text areas, same number and name. These text areas having transcripts that can be translated into multiple different languages and either listened to or read in them, thereby being a good complement to the presentations up top. Closing out the icon, we have our information up top that will then go through the calculations in the blue area down below. We're considering the preferred stock valuation. Remember that the preferred stock valuation is a little bit easier in some ways than the common stock valuation, because common stock, we're considering the value of the company and as well as the return, which would be basically the dividends. Common stock generally being thought of as the ownership of the company. Preferred stock, we're focusing in on to the dividends that will be related to the preferred stock and the return related to them. So we're looking for then the value here, our information, annual dividend, we're saying is $12, and the yield or required rate of return on the market, 10% to start off with, and then 7%. Now, on the original issuing of the preferred stock, we would think that they would basically, if they want to issue the stock, take into consideration what the market rate is, the required rate on return, in considering the original price. And so we'll start there, and then we'll see how that value could change as the market rate of return will then change. So we're going to take our calculation, fairly basic starting point. We're going to say that the dividends are going to be the 12%, the yield or required rate of return, $12. The yield or required rate of return then being the 10%, the 12 divided by 10, giving us the 1. So we're simply taking the 12 return with the dividends that we're going to get divided by the rate is 0.1 or 0.1, and that's going to give us then the 120. In other words, if we were to purchase the stocks at the 120 and we have a required rate of return of the 10%, that return in the form of dividends, we paid 120, required rate of return, 0.1, 10%. That would get us, of course, back up then to the $12. So you can also kind of think about this just to play with the present value and future value kind of calculations. If we took, for example, the future value of one type of calculation, and we were to consider the future value of our transaction here then. For example, if you're going to calculate the future value and take the 120, which is going to be the price up top, the 120, which is going to be the amount of the present value. So the rate we're going to say is going to be the 10%, comma, number of periods, we're going to assume one period out, comma, comma, and then the future value, then the present value, the price that we just figured out to be the 120, that would then give us the 132 that we expect the future value to be. In other words, if we paid the 120 and got then the 10% return using our future value type of calculation, if we were to take that amount, the 132, where we expect to be a year from now after the dividend, subtract out the dividend, then that would get us back to the 120, just to kind of play with our future value and see this in a couple different ways, getting us back then to the investment of the 120. Just to look at an annuity formula, let's kind of figure this out and project like 5 years into the future. We're going to say then future value of the rate's going to be that 10%. Number of periods, we're just going to put 5 here, so we're projecting out 5 years, comma, the payment we're assuming is going to be then the 120 times the required rate of return, which is going to be 10%, which will give us that 12. And if we were to take that and add then the 120 to it, our original investment, we would get then the 193, our future value type of calculation. If we compare that to what we consider basically the stream or value of the dividends that we're going to basically have, the $12 dividends, and we take the future value of the 12 dividends, giving the rate of return of 10%, negative future value, the rate's going to be the 10%, number of periods, once again 5, we're just projecting 5 periods out, and then the payment this time going to be the dividends, the $12, so that's going to be the 73. Subtracting those two out would once again give us to the 120. So you can kind of experiment with a couple different ways to work these problems over, just roll them over and in your mind. We do this in Excel too. You can put this information into Excel and work it multiple different ways. And so if you want to look at that, we do have a practice problem in on it. Now let's say that there's a change here. We're going to say now the dividend 12, and then it's going to go down with regards to the required rate of return, now 7%. So what's that going to do? We had the 120 before. What's that going to do to our value? We're going to take the 12, we're going to divide it by the yield, which is now the 7%, the value now having gone up to the 171. So we're taking then the 12 divided by the 0.07. That's going to give us our 171 current value. Now, of course, why would that be? We're saying, well, now if you're talking about the preferred stock, I can only get 7%. That's my required rate of return, meaning going somewhere else, I could get then the 7%. So now the $12 dividends, as the rate goes down, means that the value is going to be higher now so the value is then higher at the 171. So now if we have the 171 times the 0.07, that would then give us our about the $12 dividend if we went the other way, meaning if I put in the 171 expecting then a 7% return, that would then give us the $12. So you can see then as the expected rate of return goes down, then the value or price you would expect then to go up. So then let's go on down. If you did the same, kind of just worked it a few different ways with our future value calculations as we did before. If we had the future value of 1, you can expect then the rate is going to be now the 7%, comma, number of periods now 1 period out, comma, then the present value we're going to pick up then the 171. That would give us the 183, the expected future value. If we compare that to the $12 dividend that we're going to then be paying, subtracting that out, that would give us the 171, once again, the price. So you can work this a couple different ways in your mind. You can do that annuity calculation. Let's imagine 5 years out. Where would we be in the future value 5 years out? Well, we can say the future value is going to be the rate 7%, number of periods now 5, comma, the payment we're going to say is going to be the 171 times the 7%, and then the times the 7%, and then we're going to add that to the 171. That would mean we expect to be in 240 at the future. If we then took the future value of the annuity of the payments for 5 periods, imagine 5 periods out, future value of the rate 7%, number of periods we're now saying 5, and then the payment then being the $12, this being the sum of the dividends we would expect, and we subtract those out, we once again get back to that 171. So you can kind of work it in your mind a few different ways to kind of make this make sense to you. We do recommend doing that in Excel, and we do work this problem in Excel, so you can check that out.